I just got off the phone with a client. Let's call him John. John lost $100,000 in lifetime benefits simply because he checked the wrong box on his Social Security application. He thought he was being smart by claiming early to invest the money. But he didn't account for the earnings limit, or the tax torpedo. By the time he realized his mistake, it was too late. He had locked in a permanently reduced check for the rest of his life. And the worst part? The Social Security Administration employees are not allowed to give you financial advice. They are just there to process the paperwork. If you make a mistake, they won't stop you. It is permanent. Hi, I am Thomas Wright. In this video, I am going to save you from John's fate. We are breaking down the top 5 Social Security filing mistakes people are making right now in 2025. Mistake number 3 is something 40% of married couples get wrong, leaving thousands of dollars on the table. And mistake number 5 involves a hidden tax calculation that could eat up 85% of your check before it even hits your bank account. Do not file a single piece of paperwork until you watch this video. Mistake number 1, the break-even obsession. Everyone asks me, Thomas, if I take benefits at 62 instead of 70, when do I break even? Usually, the math says somewhere around age 78 or 80. So people think, I might die before then. I'll take the money now. This is short-term thinking. And honestly, it is the wrong way to look at insurance. You don't buy car insurance hoping to crash your car to break even on the premiums, right? You buy it for protection. Social Security is longevity insurance. It is the only income stream you have that is guaranteed to last as long as you do, and it is adjusted for inflation. Think about this. If you live to age 95, which is becoming very common, claiming at 62 means you accepted a 30% permanent pay cut for over 30 years. By age 85, inflation will have cut your purchasing power in half. If you started with a small check, you are going to be in poverty in your 90s. Delaying to age 70 gives you the highest possible monthly income to protect the old you from running out of money. Do not bet against your own life expectancy. Mistake number 2, working while collecting early. This is huge for 2025 because so many seniors are working part-time to fight inflation. Here is the rule. If you claim benefits before your full retirement age, FRA, which is between 66 and 67 for most of you, and you continue to work, you are walking into a trap. In 2025, the earnings limit is projected to be around $23,400. For every $2 you earn above that limit from a job, the government takes back $1 of your Social Security benefits. I have seen people earning $50,000 a year part-time, and they are shocked when they receive a letter from the SSA saying their benefits are being suspended. They effectively worked for free because every dollar they earned just canceled out a dollar of benefits. Now technically, you get this money back later, when you hit full retirement age. But most people don't live long enough to recoup the loss. If you plan to keep working, do yourself a favor. Delay claiming Social Security until you stop working or reach your full retirement age. Period. Mistake number 3, ignoring spousal and survivor benefits. This is the one that costs widows the most money. Did you know that you can claim up to 50% of your spouse's benefit if it is higher than your own? Even if you never worked a day in your life? But here is the mistake. People assume this happens automatically. It does not. You have to ask for it. And it gets more complicated with survivor benefits. When one spouse dies, the smaller Social Security check disappears, and the surviving spouse keeps the larger one. If the higher-earning husband claims at 62 to get early money, he is locking in a permanently lower survivor benefit for his wife if he dies first. By rushing to claim early, he is effectively defunding his widow's future. If you are the higher earner, you have a moral obligation to consider delaying your claim to age 70, not just for you, but to maximize the check your spouse will live on after you are gone. If you are finding this helpful, please subscribe. We are building a community of smart retirees. Mistake number 4. Forgetting about provisional income. We talked about this in a previous video, but it bears repeating because it is deadly. Most people think Social Security is tax-free. It is not. Up to 85% of your benefits can be taxed if your provisional income exceeds just $34,000 for singles or $44,000 for couples. Here is the common mistake. People retire at 65 and start withdrawing heavily from their traditional IRA or 401k to delay Social Security. They think they are being smart. But when they finally turn on Social Security at age 70, their required minimum distributions, RMDs, from those 401ks kick in at age 73. Suddenly, they have Social Security income plus mandatory 401k withdrawals. This pushes their income way over the limit. The result? They pay taxes on 85% of their Social Security plus ordinary income tax on the RMDs. This is called the tax torpedo. You need to use the years between retirement and age 70 to do Roth conversions to lower your RMDs later. Do not just sit on your 401k time bomb. Mistake number 5. Leaving ex-spouse money on the table. This is a secret that millions of divorced Americans don't know. If you were married for at least 10 years and you are currently unmarried, you can claim benefits on your ex-spouse's work record. It does not matter if they have remarried. It does not affect their benefits. And the best part? They do not even need to know. You don't need their permission. You just need to prove the marriage lasted 10 years. I have seen women living in poverty on a tiny Social Security check, not realizing they could be claiming a much larger spousal benefit from an ex-husband who was a high earner. If you fit this description, go to the Social Security office with your marriage and divorce decrees. It could double your monthly income overnight, and because I want you to be fully prepared, here is a bonus mistake: not checking your state laws. We talk a lot about federal taxes, but did you know that 9 states still tax Social Security benefits? If you retire to Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, or West Virginia, you might get a nasty surprise from the state tax collector. Before you pick your retirement destination, check the local tax laws. Moving just across the border to a tax-friendly state could save you thousands of dollars a year in retirement. Social Security is complex. One wrong box, one wrong date, and you lock in a lower income for life. Don't be like John. Measure twice, cut once. I have created a full playlist on how to calculate your taxes and maximize your benefits. You can watch that deep dive video right here. I am Thomas Wright. Smart planning pays off. I'll see you there.